Welcome back to Portfolio, everyone. And in this video, we're going over 6 high-yielding healthcare stocks you can add to your portfolio today if you want to have some nice, high, consistent income coming in to your portfolio each and every quarter. So these are high-yielding stocks. They all operate within the healthcare sector and provide nice, consistent cash payments to investors every 3 months. So we're going to go over each different company, take a look at how they've performed over the past 12 months, take a look at their current dividend yield, payout ratio, and actually evaluate their dividend safety score to determine if we like them for our portfolio today. So these are more income-oriented stocks. In no way are these growth stocks. These are high-yielding stocks where if you want consistent payments and you want that high income currently, you want that income coming in today, these are the stocks you want to take a look at. So as you know, everyone, I am the Gen Z Investor, and every single day on this channel, we talk about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So please like and subscribe, and we're going to get right into the first pick on this list, which is ticker symbol GILD, Gilead Sciences. Currently being traded around $66 a share. Over the past 12 months, they were up 5.7%. You can see here they did peak somewhere past the month of April, but then they have seen somewhat of a steady decline over the past 2 to 3 months. Current market cap at around $82 billion, and trading towards the low side actually on the 52-week range. Their current dividend yield is around 4.12%, and they actually have a payout ratio close to 39% of earnings. So a sustainable payout ratio. They have a lot of money to keep within the business to reinvest and grow operations, and they actually have a lot of room left over to actually hike that dividend payment each and every year. They've been growing their dividend for 5 consecutive years, and if you take a look at their dividend growth history, they've done a nice job of increasing that quarterly payment each and every year over those past 5 years. With regard to how safe that dividend is, they currently have an 83 dividend safety score from Simply Safe Dividends, which represents a very safe dividend. And this is a company where you don't have to worry about that dividend payment getting cut anytime soon. This is a company where over the short term, their dividend payment should be sustainable and can actually grow each and every year over the next 1 to 3 years. And we're going to take a look at this company and actually talk about they have a low beta. So this company is not as volatile as the overall market. So there's not going to be a lot of price movement in your portfolio if you hold a company like Gilead. So what this is important is if you're looking for a nice high income stock, you want to collect that nice high dividend yield at above 4%, but you don't want a lot of price volatility and you want to somewhat stabilize your portfolio, this is a company you may want to take a look at. Number 2 on our list today is another well-known company, which is Pfizer, ticker symbol PFE, currently around $38 a share. 12-month performance up around 13%. They did see March lows, have slightly recovered, another small dip by the end of June, but once again another recovery back to somewhat near pre-pandemic levels. 52-week range towards the high side, but nowhere near that 52-week high, and a market cap at around $215 billion. Pfizer actually just got removed from the Dow Jones Index, but it's funny to think that statistics have shown that companies will actually get removed from the Dow over the 12 months following that change and that transition. They actually outperform the companies who get added into the index. So it'll be interesting to see if Pfizer performs better than the companies they were replaced with over that next 12-month span. Pfizer is another high-yielding stock. Current yield just shy of 4% at 3.91, with a payout ratio of 53%. So another company with a sustainable payout ratio of earnings. They have enough money to stay and reinvest back to the business, and there's a lot of wiggle room to grow the dividend over the next coming years. And they've done a beautiful job of growing their dividend payment at around a 3.7% average over the past 5 years, which is very nice to see. And over the past 10 years, they've grown their dividend each and every year. If we take a look at dividend safety score, currently ranked at 75, which is considered safe. So a dividend where over the short term, once again, kind of unlikely that it gets cut. Your dividend is sustainable over the next coming years, and that number will change or go down if anything changes with the business, but at its current point in time, the dividend is safe. Stock number 3 on our list is ticker symbol SNY, Sanofi, at around $51.73 a share, trading up 21% on the 12-month chart. This is another high dividend yielding company with a market cap at around $129 billion. Currently yielding 3.3% and a payout ratio of around 49% of earnings. So once again, a company with a sustainable payout ratio. Although the dividend growth rate shows negative here, if we take a look at the longer term perspective, you can see they've always paid a very fluctuating dividend. They only pay their dividend once a year. They pay an annual dividend. And you can see here that it has been fluctuating every year over the past, I'm going to say 15 years. But over the long term, slight upward trend in dividend payments. If we take a look at their dividend safety score, they actually have the highest dividend safety score on this list today with a score of 90. So another very safe dividend where it's very unlikely to be cut or reduced anytime soon. Stock number 4 on our list today is ticker symbol ABV, ABBV, just over $94 a share, up a massive 43% over the past 12 months. So this is a company that has seen insane surges over the few recent months. You can see they saw March lows, full recovery, and continue to trade above pre-pandemic levels. Current market cap at around $166 billion. This is another massive company. With their current yield at just shy of 5% at 4.99% and a sustainable payout ratio of around 45% of earnings. This company has done a great job of growing their dividend payment each and every year. They have a 7-year dividend growth streak, but over the past 5 years, they're averaging over 20% annual dividend growth, which is absolutely incredible, especially when you're locking in a 5% current yield if you purchase today. With regard to dividend safety though, currently ranked at 50, so considered borderline safe. So this is a company where there is a risk of that dividend getting cut over the next few years, but it's currently still somewhat safe. So that's what it means by borderline safe. And again, another company with a low beta. So for all 4 of these companies have had a low beta. These are companies where there are not a lot of price volatility compared to the overall market. Moving on, stock number 5 of another healthcare high dividend paying stock we have to take a look at is ticker symbol NVS Novartis AG at around $86 a share. This company is down 2.33% on the 12-month chart. You can see here before the pandemic, they did see a slight surge. Pre-pandemic high at around $99 a share. Then of course you saw that March lows, and this company has not fully recovered back to that pre-pandemic level, which may make this a nice buying opportunity. Market cap at around $109 billion and a nice current dividend yield at around 3.58%. Another company with a sustainable payout ratio at only 54.5% of earnings, but very slow dividend growth. This is a younger paying dividend company and they do not have a long dividend growth history. If we take a look at their dividend safety score, currently ranked at 61, considered safe, but on the low end of the safe category. So another company where, as of right now, their dividend shouldn't be at risk, but over the long term, if they don't make any fundamental improvements to the company's financials, then that dividend may be at risk over the next maybe 2 to 4 years. The final company on our list today is ticker symbol GSK, currently being traded at $40 a share. Over the past 5 years, this company is very flat. So over 5 years of trading, barely any price volatility, and the shares are at 0.17% gain over a 5-year time horizon. Over the past 1 year, shares are down 2%. You can see that they did see a nice surge, but over the past 5 years, still flat. Over the past couple months here, back in 2020, pre-pandemic high all the way up around $48, $49 a share. Saw those March lows, slight recovery, but nowhere near where they were trading at that pre-pandemic high. Market cap just shy of $100 billion with around $99.21 billion market cap. Another company with an insanely high yield right now at around a 5% dividend yield at its current point in time. And they do have somewhat of a high payout ratio of around 77.7%, which is above my nice 75% threshold for dividend payout ratios. So this company would not be going into my personal portfolio. If we take a look at their dividend history over the past couple of years, they've been paying out a dividend for a long period of time, but you can see here that dividend has always been fluctuating. Since 2002, a nice upward trend over the long term with regard to their dividend payments, but always consistently fluctuating quarter over quarter, which may be not the best if you're looking for consistent income where you want that same dividend payment where you know exactly what to be expected over the next coming years. But overall, a very nice high yielding stock at its current point in time. And if you're okay with that fluctuation in dividend payments, this may be one you want to do some research into. All these companies you have to look into before you invest. In no way is this a full analysis on these companies, just a brief overview to try to introduce you and maybe give you some ideas of companies you want to research on your own. And to wrap up this list, they have a 49 dividend safety score, which is considered borderline safe. So once again, another company where their dividend is kind of at risk to be cut at its current point in time, but if they can improve fundamentals or have a couple of good quarters, they can bounce back, fix their overall financial statements, and that dividend is still considered safe. So those were 6 high-yielding dividend stocks. They all operate within the healthcare sector. The healthcare sector has some consistent cash flows coming in each and every year, and this is a sector of the market that takes up a decent chunk of the S&P 500 and should be a nice contributing part of a nice portfolio. So if you're looking for some nice high yield, if you want some income-oriented stocks, those are some 6 you should take a look at. Always do your own research. None of these are recommendations. These companies, all you need to do a full in-depth analysis. This was just a very brief overview to show you short-term price movement, current dividend yield, and somewhat dividend safety. So thank you for tuning in, everyone. I'm the Gen Z Investor, and I will see you in tomorrow's video.